You turn on the financial news and everything looks strong. Markets are hitting record highs. Economists say growth is stable. Unemployment numbers look healthy. Corporate profits keep breaking records. On paper, this should feel like one of the strongest economic periods in modern history. But talk to people around you for a moment. Ask your friends, ask your co-workers, ask your family. Why does everyone feel poorer? Why does it feel harder to buy a home than it did for previous generations? Why does every grocery trip feel more expensive? Why do salaries feel like they are standing still while everything else keeps rising? Something does not add up. If the economy is doing so well, why does it feel like something is deeply wrong? This is not just a feeling. It is a paradox that millions of people around the world are experiencing at the same time. The official story says prosperity is everywhere. The lived experience says the opposite. And when two realities exist at the same time, one important question appears. Which one is real? To understand this strange contradiction, we need to step outside the headlines and look at the system itself. Not the version presented on television, the actual system underneath it. Because once you see how the financial machine truly works, the global economy starts to look very different. This way of analyzing the system draws from ideas developed by Ray Dalio, cycles economicos, Nassim Taleb, sistemas frages, Daniel Kahneman, Psicologia Económica y Howard Marks, ciclos de mercado. And when you look through that lens, the unsettling possibility emerges. The economy may not be broken. It may simply be operating exactly the way the system was designed to operate. There are actually two economies running at the same time. The first one is the economy you see in headlines. This economy is measured through a handful of indicators that dominate financial news every day. Stock market indexes climbing higher. GDP growth reports showing expansion. Corporate earnings breaking new records quarter after quarter. These numbers create a powerful narrative. They suggest progress, stability, and prosperity. But there is another economy that rarely appears on those charts. The economy people actually live in. This is the economy of rent payments, grocery bills, healthcare costs, and wages that struggle to keep up with rising prices. It is the economy where people work more hours, yet feel less financially secure. The problem is not that the official numbers are fake. The problem is that they measure the system, not the human experience inside the system. Stock markets measure asset values. GDP measures production. Corporate profits measure the success of companies. None of these indicators measure whether the average person is becoming more financially stable. And when the indicators used to describe prosperity become disconnected from real living conditions, something unusual begins to happen. The economy looks healthy from far away, but up close, it feels increasingly artificial. That feeling is the first clue that something deeper is happening beneath the surface. And to understand why, we need to examine the engine that has been quietly driving the global economy for the past 2 decades. Liquidity, the liquidity machine, money that was never really earned. To understand why the global economy can look strong while people feel financially squeezed, you need to understand one powerful force that quietly reshaped the system over the last 2 decades. Liquidity. Most people imagine money entering the economy through work, productivity, and innovation. Businesses create value, workers earn income, profits are reinvested, growth follows productivity. That used to be closer to reality. Today, a large part of economic expansion comes from something very different: money creation. After major crises, especially after the financial collapse of 2008, central banks around the world began injecting enormous amounts of liquidity into the financial system. Interest rates were pushed close to zero. Governments introduced massive stimulus programs. Central banks expanded their balance sheets to unprecedented levels. This process increased the supply of money circulating inside financial markets. At first glance, this seems positive. More liquidity stabilizes markets and prevents economic collapse, but it also creates an unintended effect. Asset prices begin rising faster than the real economy. Stocks rise, real estate rises, financial assets expand in value even if productivity grows slowly. The system begins to look prosperous because the numbers tied to asset values keep climbing. This dynamic reflects the debt cycle patterns described in the work of Ray Dalio, Cycles Económicos, Nassim Taleb, Sistemas Frágeis, Daniel Kahneman, Psicologia Econômica, e Howard Marks, Ciclos de Mercado. Liquidity can create the appearance of prosperity, even when underlying productivity stagnates. This is why the financial world can experience massive wealth expansion while the daily economic experience of most people changes very little. Money is flowing. But it is not flowing everywhere, and that leads to the next layer of the illusion, where this liquidity actually goes. The asset bubble effect, when money flows upward. Now we arrive at one of the most important and least discussed mechanics of the modern financial system. Liquidity does not spread evenly across the economy. When central banks inject money into the system, it does not land equally in every household, every paycheck, or every community. It enters through specific channels. Banks, financial institutions, investment markets. From there, the money flows primarily into assets. Stock markets receive new capital. Real estate markets absorb cheap credit. Venture capital funds pour money into speculative projects. Large corporations use low interest rates to borrow heavily and buy back their own shares. Asset prices begin rising. Homes become more expensive. Stocks reach new records. Luxury assets explode in value. On the surface, this looks like prosperity. But something critical happens at the same time. Wages do not rise at the same speed. Productivity grows slowly. Salaries move gradually. Meanwhile, the cost of assets that define financial security, housing, investments, retirement portfolios, rises dramatically. This creates a silent divide inside the system. People who already own assets see their wealth expand rapidly. People who rely mainly on wages struggle to catch up with the rising cost of the financial world around them. The system starts rewarding ownership more than effort. This dynamic is deeply connected to the market cycle thinking described in the work of Ray Dalio, Economic Cycles, Nassim Taleb, Fragile Systems, Daniel Kahneman, Economic Psychology, E. Howard Marks. Market cycles. When liquidity inflates asset prices faster than real economic productivity grows, the system begins to feel distorted. From a distance, the economy looks stronger than ever. But inside everyday life, the gap between the financial economy and the lived economy continues widening. And when that gap grows large enough, another powerful force enters the system. Narratives. Because when reality becomes difficult to explain, systems begin telling stories. The narrative economy, the stories that hold the system together. At this point, something strange begins to happen inside complex economic systems. When the numbers stop matching everyday experience, explanations become necessary. This is where narratives enter the system. Markets do not run only on capital. They run on belief. Investors need confidence. Consumers need optimism. Institutions need stability. Without these elements, financial systems become fragile very quickly. Because of that, economic communication is rarely neutral. Governments highlight positive indicators. Financial media emphasizes growth numbers. Central banks carefully frame policy decisions using language designed to maintain confidence. This does not mean people are lying. It means the system depends on maintaining belief in its stability. The moment collective confidence collapses, financial markets can move violently. Credit can freeze. Investment can disappear almost overnight. This relationship between perception and decision-making is deeply connected to the behavioral research of Daniel Kahneman, Psychologia Economica. Human beings do not respond only to data. They respond to stories that help them interpret complex realities. Narratives simplify uncertainty. When stock markets rise, the narrative becomes technological innovation, economic resilience, or global recovery. When inflation appears, the narrative may describe it as temporary pressure or supply chain adjustment. Each narrative helps maintain coherence inside a system that is incredibly complex. But narratives have limits. If the lived experience of millions of people diverges too far from the official story, skepticism begins to spread. People start asking questions. Why do markets look healthy, while daily life becomes more expensive? Why do financial indicators celebrate growth, while households feel pressure? Those questions signal that the narrative layer is beginning to crack. And when narratives begin to crack, the next risk emerges: system fragility. The fragility problem: when stability becomes the risk, complex systems often look strongest right before they reveal how fragile they really are. Modern financial systems are built to reduce volatility. Central banks intervene to stabilize markets. Governments introduce stimulus when growth slows. Financial institutions develop increasingly complex tools to manage risk. At first glance, this seems responsible. Instability is dangerous for economies, so the system constantly tries to smooth shocks and prevent crises. But this creates an unexpected side effect. When systems are constantly stabilized, hidden risks accumulate beneath the surface. Small corrections that would normally release pressure are suppressed. Asset prices continue rising. Debt continues expanding. Confidence grows stronger because the system appears resilient. This is the dynamic described in the work of Nassim Taleb, Sistemas frágeis. Systems that appear stable for long periods can become increasingly vulnerable because hidden fragilities keep building inside them. History offers several examples. The dot-com bubble of the late 1990s created enormous optimism about technology markets before collapsing suddenly in 2000. The housing market in the United States looked extremely stable before the financial crisis of 2008 revealed how fragile the credit system had become. Japan experienced a massive real estate and stock market bubble in the 1980s that eventually led to decades of stagnation. In each case, the same pattern appeared. The system looked stable. Confidence was high. Most people believed the expansion could continue indefinitely. Then the underlying fragility revealed itself all at once. This cycle reflects the deeper insights explored by Ray Dalio, Ciclos Econômicos, Nassim Taleb, Sistemas Frágeis, Daniel Kahneman, Psicologia Econômica e Howard Marks, Ciclos de Mercado. The more a system depends on maintaining the appearance of stability, the more dangerous the moment becomes when that stability breaks. And this leads us to a pattern that quietly repeats across financial history: the psychological cycle of markets. The cycle nobody talks about, the psychology of markets. They move in cycles driven by human psychology. Every major market expansion follows a pattern that has repeated for centuries. At the beginning of the cycle, pessimism dominates. Investors are cautious. Capital is scarce. Opportunities appear only to those willing to take risk when others are afraid. Then recovery begins. Prices slowly rise. Confidence returns. Investors who stayed on the sidelines begin to participate again. Economic indicators improve and optimism spreads through the system. As the expansion continues, optimism becomes excitement. New technologies promise transformation. New industries attract massive capital. Financial markets celebrate innovation and growth. Success stories multiply and attract even more participants. Then something subtle happens. Excitement turns into euphoria. Risk feels smaller than it actually is. Leverage increases. Investors believe that the current environment represents a new era where old limits no longer apply. Each market cycle develops its own narrative that explains why this time is different. This psychological progression is central to the market cycle framework discussed by Howard Marks, Ciclos de Mercado, alongside the broader systemic insights of Ray Dalio, Ciclos Econômicos, Nassim Taleb, Sistemas Frágeis e Daniel Kahneman, Psicologia Econômica. Eventually, the most dangerous phase of the cycle appears: denial. Warning signs begin to emerge. Valuations look stretched. Debt levels rise. Yet the dominant narrative insists that the system remains strong. People interpret risks as temporary disturbances rather than structural problems. This is the moment when the system looks the most stable and the most fragile at the same time. Because once confidence shifts, the cycle can reverse far faster than it expanded. And when that reversal begins, the illusion separating the financial economy from the real economy becomes impossible to ignore. Which brings us to the deeper explanation behind the strange feeling many people share today: why the economy feels artificial. The real reason it feels fake: Three economies inside one system. At this point, the pieces start coming together. The strange feeling that something is off in the global economy does not come from a single cause. It comes from the collision of three different economic realities that now exist inside the same system. The first layer is the financial economy. This is the world of stock markets, bonds, venture capital, derivatives, and global capital flows. In this layer, trillions of dollars move across markets every day. Asset prices react instantly to liquidity, interest rates, and investor sentiment. When liquidity is abundant, this economy expands rapidly. The second layer is the statistical economy. This is the economy measured by official indicators: gross domestic product, inflation indexes, employment statistics, productivity reports. These numbers attempt to describe the system through models and averages that simplify an extremely complex reality. But there is a third layer that often diverges from both: the lived economy. This is the economy of households trying to afford housing, education, healthcare, and daily life. It is the economy of wages, expenses, and financial security. It is the layer where people feel directly whether the system is improving or becoming more difficult. When these three layers move in the same direction, the system feels coherent. Growth appears real because financial markets, economic indicators, and daily life reinforce the same story. But when the layers separate, the system begins to feel artificial. This disconnect explains why many people feel that the economy is strong and fragile at the same time. This perspective reflects the broader systemic thinking explored through Ray Dalio, economic cycles, Nassim Taleb, fragile systems, Daniel Kahneman, economic psychology, Howard Marks, market cycles. The system is not necessarily fake, but the signals used to describe it no longer capture the full reality people experience. And that leads to one final question. A question that changes the way you interpret everything you hear about the economy. The hidden question. If the system produces record asset values, rising financial markets, and stable macroeconomic indicators, while millions of people feel increasing pressure in daily life, then one possibility begins to emerge. The economy might not be broken. It might be operating exactly as it was designed. Modern financial systems are optimized to stabilize markets, protect capital flows, and maintain institutional confidence. These priorities can produce stability at the top of the system even while pressure grows beneath it. Once you understand this structure, the global economy stops looking mysterious. It starts looking like a machine driven by liquidity, narratives, cycles, and human psychology. And once you see the machine, you begin asking a different question. Not whether the economy feels fake, but whether you are looking at the same economy that the system itself is designed to measure. The hidden question. Is the system broken or working perfectly? At this point, the uncomfortable realization appears. The strange feeling that the economy looks strong while life feels harder may not be a mistake in the system. It may be the result of how the system is designed. Modern economies are not engineered primarily to maximize comfort for every participant. They are engineered to maintain stability, preserve financial flows, and protect the infrastructure that allows markets to function globally. That means the system prioritizes liquidity, credit stability, institutional confidence, and capital movement across borders. When those elements remain stable, the system considers itself healthy. Stock markets rising signals confidence. Corporate profits expanding signals productivity. GDP growth signals economic activity. But these signals do not necessarily measure how evenly prosperity is distributed across society. This structural perspective appears repeatedly in the thinking of Ray Dalio. Economic cycles, Nassim Taleb; fragile systems, Daniel Kahneman; economic psychology, Howard Marks; market cycles. Large systems evolve to preserve their own continuity. They stabilize what is critical to their survival. And sometimes the parts that become unstable are the ones closest to everyday life. That is why financial markets can celebrate growth while households feel pressure. The machine is stabilizing capital flows, not personal balance sheets. Once you recognize this dynamic, the feeling that the economy is fake begins to transform into a deeper understanding. The system is real. But the signals used to describe it often reflect the perspective of the system itself, not the experience of the individuals living inside it. Which leads to the most important question you can ask when looking at any economic headline. When someone says the economy is strong, the real question is simple. Strong for who?